Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at U Power.
If you find our talks useful, please consider subscribe, like, and comment underneath. And today we really need to talk about what happened on March 17th, 2026.
Oh yeah, that was wild.
Right, because, you do not see this every day in the markets. We are talking about a micro-cap stock valued at under $8 million that essentially just went completely parabolic.
Yeah, totally parabolic.
It surged like 180%, and then it just kept climbing to hit a staggering 236% to the upside in a single trading day.
Which is it's almost unheard of.
Exactly. The momentum was so violent, so overwhelming, that it actually triggered an automatic circuit breaker halt to the upside.
Yeah, and well, when an asset reprices that aggressively in a single session, it forces that mechanical intervention. The sheer velocity of the buy orders essentially breaks the immediate plumbing of the exchange.
Right. It's kind of like, think of a circuit breaker like a bouncer at a crowded club, right?
Yeah. That's a good way to put it.
When buy orders just flood the system so fast that the clearinghouses literally cannot match the buyers to the sellers, the exchange just forces a mandatory cool down.
Yeah, so the structural integrity of the market doesn't fracture.
Right. The lights come on, trading halts, and everyone just has to take a breath. But what I really want to know is the architecture behind that rush.
Okay.
Like, is this purely retail FOMO? The fear of missing out with day traders just chasing a shiny object on social media, or are we looking at smart money accumulating a massive position?
Well, look, you have to look at the market mechanics required to trigger an upside halt on a stock that's been, otherwise totally dormant.
Right.
Retail traders, acting independently, they rarely possess the concentrated capital density to force a halt like that.
That makes sense.
So the volume profile we saw on March 17, it strongly implies heavy institutional or algorithmic buying. What we're witnessing is really the classic signature of a capitulation reversal.
Okay, let's define the mechanics of that for a second for anyone listening. A capitulation reversal basically means the broader market had previously thrown in the towel, assumed the underlying business was dead money, and is now violently reevaluating that thesis.
Exactly, and they're reevaluating it based on a tangible, concrete commercial milestone. Institutional algorithms don't reprice an asset by 236% based on some vague press release.
Right, they need real news.
Yeah. The catalyst that sparks this frenzy was U Power announcing the production of its very first batch of 30 battery-swapping electric heavy-duty trucks. And these were specifically destined for commercial use in Thailand.
Okay, so 30 heavy-duty trucks moving into Thailand. This is where we move from the raw shock of a stock chart to actual physical infrastructure moving across borders.
Yeah, real steel and rubber.
But, 30 trucks doesn't really sound like a fleet that changes the world, Why did the market react so aggressively to this specific number?
Well, because it validates the international viability of a highly complex logistical model. Look, heavy-duty commercial trucks are not, passenger sedans.
Right.
We are talking about vehicles moving 40 to 80 tons of freight. You cannot simply plug a heavy-duty electric truck into a standard charging port and tell the driver to wait 8 hours for a full battery.
Yeah, that would be a disaster for shipping.
Exactly. In the commercial supply chain, idle time is destroyed capital. So the Thailand order proves that fleet managers are actually willing to adopt a different mechanism, and that's swapping.
Which brings us to the actual technology itself, because U Power isn't just selling trucks, right? They're basically operating 3 distinct revenue streams.
Correct.
They sell the battery swapping stations themselves, they provide sourcing services to the operators, and they manage the ongoing battery swapping services.
Yeah, and the underlying engine of all 3 of those streams is their proprietary modular battery swapping technology.
The UOTA system.
Right, UOTTA. And the key word there is definitely modular.
So explain the mechanics of that modularity, because honestly, when I picture a truck battery, I picture one massive, incredibly heavy block seamlessly integrated into the floorboard.
Yeah, well, that is the traditional EV architecture, and it's terrible for commercial swapping.
Why? Just too heavy.
Way too heavy to move quickly. So UOTA's modular approach breaks the power source down into standardized, easily removable battery bricks.
Oh, interesting.
Yeah, instead of swapping one massive block, a robotic station just swaps multiple smaller modules based on the truck's specific route requirements.
Okay, wait, so if a truck only needs enough range for a short urban delivery.
Then the station only loads the necessary modules.
Yeah.
It reduces the vehicle's weight and significantly improves its efficiency.
Wow. I look at that business model, and the analogy that immediately comes to mind is the Apple ecosystem.
Oh yeah, for sure.
Like once you buy an iPhone and then you get the Mac and your photos are all locked into iCloud, the psychological and financial switching costs to move to Android are incredibly high.
Yeah, it's a massive hassle.
It feels like U Power is building a hardware ecosystem for commercial logistics. Like, once a major automaker designs a heavy-duty vehicle platform around the physical dimensions of that UOTTA modular standard, they are practically locked in.
They absolutely are. That hardware lock-in is the entire moat. And you look at the original equipment manufacturer partnerships they've already secured.
Right. Massive heavyweights.
Yeah, like Dongfeng, FAW, Chery, and major battery producers like Gotion. I mean, to get a legacy automaker like Dongfeng to alter their chassis engineering to fit the UOTTA standard, that is a monumental feat.
I can imagine.
If Dongfeng ever wanted to move to a competitor swapping standard, they would literally have to re-engineer their entire production line. It's the ultimate razor and blade business model.
U Power sells the razor and then continuously generates revenue from the swapping services and the battery management, the blades.
Exactly. It creates this incredibly sticky recurring revenue that just scales with the fleet's utilization.
But it goes beyond just one automaker, right? If FAW and Dongfeng are both using the same UOTTA standard, you start to see real network effects.
Yes. And network effects in physical infrastructure are where valuations just explode. Power already has active operations in places like Hong Kong, Portugal, Peru, and Mexico.
Right.
So every time a new UOTA station comes online in any of these markets, the entire network becomes exponentially more valuable for everyone involved.
Because for the automaker, it means their vehicles can be sold and operated in more regions without the buyer experiencing range anxiety.
Exactly. And for the logistics company buying the truck, it means guaranteed uptime. And remember, they were the very first global battery swap tech stock to list on the NASDAQ back in 2023.
So they have a real first mover advantage in laying this groundwork.
Huge advantage, yeah.
Okay, so let me recap. We have sticky proprietary tech, we have heavy hitter OEM partnerships, and we have an international footprint expanding into emerging markets like Thailand and Peru. But here is the friction point. Great technology and good partnerships do not automatically translate to a rising stock price.
Very true.
We see companies with brilliant engineering languish in the public markets for years, right? So why did the stars suddenly align in early 2026? What was the financial and macro-environmental cocktail that allowed this specific breakout?
Okay, so it was really a confluence of three major macro tailwinds that resolved almost simultaneously. We had to start with the capital structure.
Okay.
There was a massive institutional overhang on the stock that finally cleared. A major lockup agreement for ordinary shares expired on November 23, 2025.
Got it. Let's contextualize that lockup expiration for a second because, we all know how retail investors get crushed when insider shares flood the market post-IPO.
Oh, absolutely.
When a company goes public, the insiders and early institutional backers are legally barred from selling for a set period. And once that lockup expires, there is usually this massive wave of selling pressure that actively suppresses the stock price.
Right. And in a microcap stock with incredibly low trading volume, that selling pressure acts like a wet blanket.
Yeah, no new institutional buyer wants to build a position while early investors are actively dumping shares on the open market.
Exactly. But once that specific November 2025 overhang washed out, the float was suddenly clean. It allowed new funds to accumulate shares without fighting that constant headwind of insider selling.
Okay, so the financial plumbing was finally clear. But that's just the mechanics of the stock. What about the mechanics of the business?
Right, so that brings us to the macro supply chain, which is the second tailwind. In February 2026, the U.S. Supreme Court issued a major ruling against the global tariffs originally initiated under President Trump.
Right, the tariff ruling.
Yeah, and look, stripping away the politics completely. From a purely economic and logistical standpoint, this ruling completely alters the math for U Power.
Because building battery swapping stations requires massive amounts of cross-border commerce, right? Like you are importing specialized steel, robotic components, high-density battery cells.
Exactly. When you're a company that relies on international logistics to build highly complex, capital-intensive infrastructure, tariff relief acts as a direct, immediate injection to your profit margins.
It just makes everything cheaper.
Right. The friction and the literal tax of moving specialized EV components across borders dropped practically overnight. It makes the entire operation so much cheaper to scale.
Okay, so the stock's capital structure is clean, and their physical supply chain just got significantly cheaper. But, I mean, reduced costs don't usually trigger a 236% parabolic run.
No, they don't.
You need a narrative that promises massive future growth. What are they doing to actually sell these newly cheap stations to fleet managers?
Well, that is the third factor. A Power executed a major strategic narrative pivot. They aren't just selling themselves as a hardware company anymore.
What are they calling themselves?
They've actively positioned themselves as an AI-integrated energy solutions provider.
Ah,
Yeah, their focus is now on connecting these heavy-duty electric vehicle fleets to smart energy grids using artificial intelligence.
okay. I am going to push back hard on this AI angle.
I figured you might.
Because, let's be honest, we are operating in 2026. Every single microcap company on the NASDAQ Q claims to be an AI company.
Yeah, it's everywhere.
I mean, I have seen mattress manufacturers claim they use AI to optimize sleep foam. So it's this real functional machine learning technology that actually impacts their bottom line? Or is this just, a highly optimized buzzword thrown into a press release to capitalize on the AI hype cycle and attract retail liquidity?
Look, that level of skepticism isn't just fair. It's basically a requirement for survival in the current market. The AI label is heavily abused,
Definitely.
but you have to look at the mechanic of what a battery swapping station actually is. It's not just a glorified garage. A swapping station holding 50 heavy-duty truck batteries is, in reality, a massive localized energy storage facility.
Okay.
And managing that level of stored power is exactly where machine learning transitions from a buzzword to a critical operational tool.
Interesting. Walk me through the actual application then. How does software change the economics of a battery station?
Primarily in two ways: predictive maintenance and smart grid arbitrage.
Let's start with predictive maintenance.
Sure. So when you're managing thousands of modular battery bricks across multiple continents, you need to know exactly when a specific cell is beginning to degrade, long before it actually fails inside a commercial truck on the highway.
Right. A breakdown on the highway is a nightmare.
Exactly. So machine learning algorithms analyze the charging cycles, temperature fluctuations, and discharge rates of every single module in real time, pulling those degrading units out of circulation automatically.
That prevents catastrophic downtime for the logistics company. If a fleet manager knows the UOTA station will only ever hand them a perfectly optimized battery, that is a massive selling point.
Massive.
And what was the second application? Arbitrage.
Yeah, vehicle to grid or V2G optimization. These stations require massive amounts of electricity, right? So AI algorithms monitor the local power grid in real time. They can automatically instruct the station to buy and store power in the middle of the night when commercial electricity rates are dirt cheap.
Oh, that's smart.
And then during peak afternoon hours, when the grid is strained and power is incredibly expensive, the AI can actually sell that stored energy back to the local grid at a premium.
Wow. So it's not generative AI writing marketing copy. It's machine learning, actively trading electricity and optimizing electrical load to reduce the operating overhead of the station.
Exactly.
If they pull that off, it fundamentally changes their margin profile.
Oh, totally. If they can mathematically prove to an enterprise fleet manager in Thailand or Mexico that their AI integration lowers the total cost of ownership compared to diesel, the adoption rate will be staggering.
Okay, all right. I need to ground us in reality for a second,
Let's do it.
because we have just built up an incredibly bulletproof, bullish pace. We have 30 truck orders in Thailand, structural lock-in with giants like FAW and Dongfeng, massive tariff relief on supply chains, and AI-driven grid arbitrage.
It sounds great, right?
It sounds too great. If the setup is this functionally perfect, I have to ask the obvious question. Why on earth is the market cap only $7.95 million? There are only 4.97 million shares outstanding.
And that, right there, brings us to the fundamental reality check of trading microcap equities. The vision is flawless, but the execution risk is terrifying.
Terrifying is the right word, because I am looking at their corporate filings right now, and they only have 80 employees.
Yep, just 80.
Hold on, 80 people. That is barely enough headcount to run a mid-sized regional logistics hub. How are 80 people supposed to manage aggressive, heavy infrastructure rollouts across Thailand, Peru, Mexico, and Portugal, while simultaneously maintaining engineering partnerships with massive Chinese auto manufacturers?
It's a tall order.
That is not running lean. That is a skeleton crew attempting to alter global infrastructure. How is that physically possible?
Well, it is the defining risk of the company. The way they're attempting to bypass that headcount limitation is by relying entirely on their OEM partners.
Okay, how so?
U Power is not sending a team of 50 engineers to turn wrenches and pour concrete in Peru. They are licensing the UOTTA standard and relying on the localized manufacturing and distribution muscle of companies like Dongfeng to actually deploy the hardware.
Ah, I see.
Yeah,
But that creates a massive dependency, doesn't it?
absolutely.
If there is a sudden regulatory delay regarding grid connectivity in Portugal or a localized supply chain hiccup with a contractor in Mexico, U Power doesn't have the internal manpower to deploy a crisis team. They are entirely at the mercy of their partner's execution speed.
Which leaves zero margin for error. And the risk profile gets significantly murkier when you look at the financials, or, well, rather, the lack thereof.
Right, the missing data.
Yeah, we are currently missing a ton of crucial structural data. The full 2025 financial figures, their total revenue, their free cash flow, and most importantly, their total debt load. That information is not yet available in the public filings.
See, that is the dark side of microcap space. We can see the 236% price surge, but we are flying blind on the balance sheet.
Exactly. We don't know their current cash burn rate. We don't know what kind of debt facilities they had to tap into to fund the manufacturing of those 30 trucks for Thailand.
Right.
And this is exactly why trading a microcap with a float of under 5 million shares is fraught with severe liquidity and volatility risks. The threat of a valuation bubble is very real here.
Because if the fundamentals don't back up the hype.
Right. If that Thailand order does not quickly translate into a broader, sustained international scaling effort with transparent revenue, the institutional algorithms that drove the stock up will just reverse course. And a stock with a 4.97 million share float will crash just as violently as it spiked.
It is the classic buy the rumor, sell the news trap on a massive scale. So sitting here listening to this, you are probably looking at that explosive chart and wondering if you missed the boat, or if you are looking at the ground floor of a massive infrastructure play. Let's synthesize all of this data into an actionable wealth-building context.
Okay, so when you weigh the proprietary UOTTA mechanics against the severe execution risks of an 80-person team, the overall bullish thesis for U Power scores a 7.5 out of 10.
7.5 out of 10.
Yeah. The technology is legitimate, the OEM partnerships are formidable, and the recent momentum is undeniably strong. But the lack of financial transparency really caps the score. From a portfolio strategy perspective, there are essentially two distinct timelines you need to consider.
Let's break down the math on those. Timeline 1.
Timeline 1 is the swing trade. This is a purely short-term strategy playing the technical momentum over the next 4 to 6 weeks. The target here is the late April 2026 Q1 earnings release.
The moment of truth.
Exactly. That earnings report is going to be the ultimate crucible. It will validate whether this rally is supported by incoming cash flow or if it was just a technical squeeze. Momentum traders will likely ride the current volume wave, leading directly up to that fundamental data release.
But if you are playing that swing, you need incredibly tight risk management. Because if the April earnings miss expectations, or if the cash burn is worse than anticipated, a microcap with a sub 5 million share float will drop like a stone.
Oh,
There
completely.
just won't be enough buyers to catch the falling knife. Okay, what is timeline 2?
Timeline 2 is the multi-year hold. We are talking about a 12 to 36-month horizon. This requires patience, a really strong stomach for volatility, and a fundamental belief in the modular swapping model.
Okay, so a longer play.
Right. If U Power can successfully leverage their OEM partners to deploy 100 or more of these AI-integrated stations across Southeast Asia, and critically, prove that their unit economics actually work in the real world, the company undergoes a fundamental re-rating.
So they transition from a speculative microcap to an established infrastructure provider.
Exactly, which could easily command a $50 to $100 million market cap.
Let's look at the actual math on that multi-year hold then. If they execute, moving from roughly an $8 million valuation today to a $50 or $100 million market cap represents a 6x to 12x upside from current levels.
It's massive.
That is the very definition of an asymmetric risk profile. But I really have to remind you, as you look at your portfolio, this is not a safe blue chip dividend stock that you buy, ignore, and let compound for 20 years.
No, absolutely not.
This is a high-risk, incredibly high-reward scenario. The potential upside is massive precisely because the risk of failure is so significant. You are betting on an incredibly lean team, fundamentally altering the logistics grid of multiple emerging markets.
Which leads to a broader, arguably more consequential question that really goes far beyond the valuation of U Power.
What's that?
Well, when you zoom out and look at the sheer amount of kinetic energy required to move millions of heavy-duty commercial trucks full of freight across the globe every single day, the traditional plug-in charging model seems fundamentally flawed for logistics.
Because time is literally money for a supply chain. A truck sitting idle at a charging station for 4 hours is a truck that isn't generating revenue.
Exactly. The supply chain demands maximum power with minimum turnaround time. So the question you have to ask yourself as an investor looking at the future of infrastructure is this: will robotic modular battery swapping inevitably completely replace traditional plug-in charging in the global commercial supply chain?
Wow. It is a massive paradigm shift to think about. If a modular standard like UOTTA becomes the default architecture for heavy industry, the companies that own the swapping network basically own the future bottlenecks of global logistics. It is a dense, highly volatile ecosystem to process, but that is exactly why we break down the mechanics behind the charts. Keep staying curious, keep digging into the details, and most importantly, keep building smart wealth. We'll catch you next time.